Have you ever, looked at a tax form and just wish someone could just give you the cheat codes? That feeling where the numbers start blurring and the regulations seem, well, impossible to really get your head around.
Oh, yeah, definitely. It's a super common feeling for business owners, payroll managers, pretty much everyone dealing with this stuff.
Exactly. But what if I told you that genuinely understanding these forms isn't just about compliance? It's actually about unlocking real financial advantages for your business and avoiding some really costly mistakes.
That's absolutely right.
So today, we're doing just that. We're taking a deep dive into one of the most essential, but yeah, often intimidating documents for employers, Form 941.
Yeah, Form 941, the employer's quarterly federal tax return. It really is the heartbeat of federal employment tax reporting for, well, most businesses anyway. It sets that quarterly rhythm for how companies report and, crucially, pay over the taxes they withhold from employee wages, plus their own share of Social Security and Medicare.
So mastering it isn't just about ticking a box.
Not at all. It's critical for managing your business's cash flow, protecting your bottom line. And while tax forms can seem incredibly dense, there are actually some surprising benefits and really crucial insights hidden in there, especially if you know where to look.
And that is exactly our mission today. We want to navigate Form 941 line by line, but with a specific focus. We're going to clarify those key calculations, definitely uncover those surprising benefits, and particularly the qualified small business payroll tax credit for increasing research activities. We'll get into that. And really shine a light on how timely, accurate filing can shield your business from some pretty significant penalties. This deep dive is for you, the listener, seeking not just info, but real clarity. Real empowerment in this, let's face it, often overwhelming world of tax rules.
Yeah.
So let's unpack this thing.
Okay, let's do it. So, starting at the beginning, the core purpose of Form 941. Think of it like your business's quarterly financial handshake with the IRS. It's the formal way you tell the government, here are the wages we paid out, here are the tips employees reported, here's the federal income tax we withheld, and critically, both the employer's share and the employee's share of Social Security and Medicare taxes.
And it covers that additional Medicare tax too, right, for higher earners.
Exactly. That's in there too. And this whole quarterly rhythm, it's designed for continuous compliance. It ensures a steady flow of tax revenue to the government, sure, but it also helps businesses manage their cash flow. Avoiding one massive, potentially crippling annual tax bill.
Right. So who actually has to file this quarterly report? Is it literally every single business with employees on a payroll?
Well, the general rule is pretty broad. If you're an employer and you pay wages that are subject to federal income tax withholding or to Social Security and Medicare taxes, then yeah, generally you have to file Form 941. That covers the vast majority of businesses operating in the U.S., so most businesses are looking at submitting this form 4 times a year.
Okay, but I bet there are exceptions. And I'm thinking some of those, especially for smaller businesses, could be like real game changers. Reducing that admin burden, which I definitely count as a form of tax saving.
You are absolutely right to flag that. This is where understanding your options really, really pays off.
Yeah.
For instance, if you're a, let's say, small employer and your annual employment taxes are consistently $1,000 or less, well, you might be eligible to file Form 944 instead.
Form 944, that's the annual one.
Exactly. An annual federal tax return instead of the quarterly 941. I mean, just imagine the administrative relief there, filing once a year instead of 4 times.
That's huge for a small operation. How do you make that switch?
So, to switch from 941 to 944, you need to contact the IRS. You can call them or send a written request. It needs to be postmarked between January 1st and March 17th. And conversely, if you're already on 944 but you expect your taxes will jump over that $1,000 threshold, you can request a switch back to quarterly 941s.
Okay, but there's a catch, I assume. You can't just decide on your own.
Right. Here's the critical takeaway. You must get a written notice from the IRS confirming the change before you actually switch your filing frequency. Don't just assume. But yeah, it's a fantastic, often overlooked way for small businesses to really streamline things, save on compliance time, maybe even costs.
That's a really significant practical tip. Reducing filing frequency is a big deal. What about businesses with seasonal workforces? Do they have to file for quarters where they have 0 employees, 0 wages paid?
Yeah, good question. Seasonal employers get a bit of a break there. They generally don't have to file a Form 941 for quarters where they genuinely have no tax liability because, well, they didn't pay anyone. However, and this is important, to let the IRS know what's going on so they don't start sending you notices asking where your return is, you have to check line 18. That's the seasonal employer box. Check it on every Form 941 you do file.
Ah, okay. So that signals to the IRS, hey, we don't operate year-round.
Precisely. It manages their expectations. A simple step, but it saves you potential hassle. And just for completeness, household employers usually use Schedule H with their Form 1040, and farm employers typically use Form 943. They generally aren't using Form 941.
Okay. Before we dive into the actual numbers, the lines on the form, let's cover those foundational admin details. What are the absolute must-get-rights on the form itself to make sure it processes smoothly? Because I'm guessing with millions of these things filed, precision is key.
Precision is definitely the name of the game for IRS processing. Number one, most critical, your employer identification number, your EIN. That unique 9-digit tax ID for your business. It is absolutely essential you use the correct one every single time.
What if you've applied but don't have it yet when the form is due?
Good point. If you've applied for an EIN but haven't received it by the due date, you should write applied for and the date you applied right there in the EIN space on the form. But definitely be warned using the wrong EIN or maybe accidentally using another business's EIN that can lead to serious processing delays, maybe even penalties. So double, triple check that EIN.
What about business changes, like a name change or moving office? Does that need a special notification?
Yes, absolutely. You need to let the IRS know promptly. For a business name change, you'd write directly to the IRS Service Center where you file your returns. If your business address changes or maybe the responsible party for the business changes, you need to complete and mail Form 8822B.
Okay, Form 8822B, got it. You don't mail that with a 941, right?
Correct. Separate mailing for the 8822B. Don't tuck it in with your tax return.
Now that quarterly rhythm, let's nail down the specific reporting periods and the due dates.
Okay, so Form 941 follows a very strict quarterly schedule, predictable at least. Quarter 1, January, February, March, that's due by April 30th. Quarter 2, April, May, June, due July 31st. Quarter 3, July, August, September, due October 31st. And Quarter 4, October, November, December. That one's due January 31st of the next year.
Okay, but I think I remember hearing about a slight extension sometimes, if you've paid on time.
Yes. Good catch. There's a practical tip here that gives you a little breathing room. If you made timely deposits that covered your full tax liability for the quarter, then you automatically get an extra 10 calendar days to file the form. So the due date becomes the 10th day of the second month after the quarter ends.
So for Q1, instead of April 30th, it would be May 10th, if all deposits were timely and covered everything.
Exactly.
May 10th instead of April 30th. Same pattern for the other quarters. It's a common grace period that many businesses rely on. And of course, the usual rule applies. If a due date falls on a Saturday, Sunday, or a legal holiday, you get until the next business day to file.
Okay. And before we jump into the actual line-by-line stuff, any quick formatting tips, things to make sure the IRS machines read it correctly because, like you said, automated systems, small details must matter.
They absolutely do. For smooth processing by those IRS systems, a few formatting points are good to know. If you're typing, using a 10-point Courier font is recommended if you can. Crucially, don't enter dollar signs or decimal points in the amount fields.
Just the numbers.
Right, just dollars to the left, cents to the right of the pre-printed decimal point. And always show the cents, even if it's zero, like 00. Also really important. Leave any data field blank if the value is 0, unless it's lines 1, 2, or 12.
Yeah.
Those need an entry even if 0.
What about negative numbers? Use a minus sign right before the number, or you can put the number in parentheses. Either works. And this one causes delays all the time. Make sure your business name and EIN are on both pages of the form, page 1 and page 2. And obviously, sign it on page 2. Forgetting the signature or missing info on page 2, that's a common slip-up that will definitely slow things down. Might even get you a notice.
Okay, good tips. Let's unpack part 1 then. The core calculations, line by line. This is where payroll data really meets tax liability. Let's start right at the top. Line 1, number of employees.
Right, line 1, it's pretty simple, just a head count. You enter the number of employees who are on your payroll for the specific pay period that includes the 12th day of the third month of the quarter.
So for Q1, that's the pay period covering March 12th, Q2 is June 12th, and so on.
Exactly. It's just a snapshot for that specific period. Seems simple, but getting it accurate is still crucial. It's one of those foundational numbers the IRS uses to kind of gauge your business size. They might cross-reference it with your W-2s later. Small discrepancies here could theoretically flag things for review. So yeah, attention to detail even here helps.
And who doesn't get counted here?
Right. You wouldn't include household employees, folks in non-pay status during that period, farm employees, they're usually on Form 943, pensioners, or active members of the U.S. Armed Forces.
Got it. Okay, moving down to line 2. Wages, tips, and other compensation. This sounds like it ties directly to what employees see on their W-2s later, yeah?
That's precisely it. The amount you put on line 2 should directly map to what would be reported in box 1 of your employee's annual W-2 forms. It's the grand total of all taxable wages, any tips your employees reported to you, and any other taxable compensation you paid out during that quarter.
Does it include things like sick pay paid by, say, an insurance company?
Yes, it generally includes sick pay paid by your agent or by a third party, like an insurance company, if you received timely notice about it, and the liability for the employer's share of taxes was transferred to you. Think of it as the total gross taxable compensation before any tax deductions come out.
Okay. Line 3 is federal income tax withheld. Seems straightforward, but any nuances beyond just what you took out of each paycheck?
Line 3 captures the total federal income tax you withheld or, importantly, were required to withhold from all those things. Employee wages, tips, taxable fringe benefits, even supplemental unemployment benefits paid during the quarter. This is purely the employee's federal income tax share. It could also technically include excise taxes on things like golden parachute payments, but that's pretty rare for most businesses. Getting this line right is fundamental. This is part of those trust fund taxes we'll probably talk more about later, the ones with really stiff penalties if they're mishandled.
All right, the trust fund taxes. Okay.
Yeah.
What about line 4? It says, if no wages, tips, and other compensation are subject to Social Security or Medicare tax. When would a business ever check that box? Seems rare.
It is very rare. You'd only check this box if, like it says, none of the compensation you reported back on line 2 is subject to Social Security or Medicare tax. This would only really apply in very specific, unusual situations, maybe certain types of governmental employers or some religious organizations with specific exemptions. For almost all standard businesses paying regular employees, this box will definitely be left blank. Your wages are almost always subject to FICA taxes.
Okay, that makes sense. Now we get into the real meat of it, lines 5A through 5E, Social Security and Medicare taxes. This is where a big chunk of the employer's tax bill gets calculated. Let's start with 5A, taxable Social Security wages.
Right, this is indeed a crucial section. Directly impacts your bottom line, your cash flow. Line 5A is where you report the total wages, sick pay, taxable fringe benefits basically, right? Anything subject to Social Security tax paid to your employees during the quarter. Now, the rate for Social Security tax is 6.2% for the employer and 6.2% for the employee. So it's a combined total of 12.4% on those wages.
So in column 2, you're calculating that total 12.4%. Column 1 wages times 0.124.
Exactly. Column 1 is the total taxable SS wages. Column 2 is that amount multiplied by 0.124.
And here's where it gets, well, really interesting for payroll planning and budgeting. The Social Security wage base limit. This seems like a critical detail for businesses, especially those with higher earners. It affects your costs throughout the year.
You've absolutely hit on a crucial point for managing your payroll costs. For 2025, that Social Security wage base limit is $176,100. What this means is, once an individual employee's total taxable wages and tips for the calendar year hit that $176,100 mark, you, the employer, stop paying the employer share and stop withholding the employee share of Social Security tax on any further wages paid to that specific employee for the rest of that calendar year.
So your payroll tax costs for that employee actually go down later in the year.
Correct. This can lead to noticeable shifts in your quarterly tax liability, especially in Q3 and Q4 if you have high-earning employees hitting that limit. But, and this is vital, remember that federal income tax withholding and all Medicare taxes continue to apply to all wages, even after that Social Security limit is reached. It's only the 12.4% Social Security portion that stops. Understanding this limit is absolutely key for forecasting your payroll expenses accurately.
That's a super important point for businesses with staff over that threshold. Okay, let's move to 5B, taxable Social Security tips.
Right. Line 5B is specifically for the tips your employees reported to you during the quarter. Just like wages, these tips are subject to that same $176,100 Social Security wage base limit. But it's the combined total of their wages and their tips that counts towards that limit for each employee. So you track them together for the limit.
Okay. And what if you couldn't actually withhold the employee's share of the tax from their wages? Say, if their tips were high but wages were low.
Very important point here. You must include all tips reported to you on this line, even if you were unable to actually withhold the employee's 6.2% share of Social Security tax from their available wages. This uncollected employee share, we'll adjust for that later, down on line 9, but you still report the full tips subject to the tax here on 5B.
Good to know. And you mentioned service charges earlier. They're different from tips.
Yeah, quick distinction. Automatic service charges added to a bill are generally treated as regular wages reported on 5A, not tips reported here on 5B. And employees generally need to report their cash tips to you by the 10th of the next month if they got $20 or more in tips that month.
Okay. Then 5C. Taxable Medicare wages and tips. What's the big difference here that businesses really need to lock onto compared to Social Security?
The key contrast, and it's absolutely vital for every business owner to grasp this. For Medicare tax, there is no wage-based limit. Zero. None.
No cap at all.
No cap at all. Medicare tax applies to all wages, tips, sick pay, taxable fringe benefits, everything. Doesn't matter how high an employee's earnings go, the rate is 1.45% for the employer and 1.45% for the employee, so a total of 2.9%. You multiply the total Medicare taxable compensation in column 1 by 0.029 for column 2. And just like with Social Security tips, you include all reported tips here, even if you couldn't collect the employee's 1.45% share. The big takeaway: no cap means Medicare tax is a constant factor on all your payroll.
Right. Okay, now 5P. Taxable wages and tips subject to additional Medicare tax withholding. This one feels newer and sometimes trips people up because it's employee-specific, right?
It certainly can be confusing. The absolute most critical point about additional Medicare tax withholding is that it's an employee-only tax. There is no employer share. Zero employer match on this one.
So it doesn't cost the business anything extra.
Correct. It's just a withholding requirement. It's an additional 0.9% tax that applies only to the wages paid to an individual employee after their earnings exceed $200,000 within a single calendar year. Once an employee hits that $200K threshold, you, the employer, are required to start withholding this extra 0.9% and keep doing it for the rest of the calendar year on all their subsequent wages and tips. Doesn't matter what their filing status is or other income.
So the calculation is just column 1 wages over the threshold times 0.009.
Exactly. You report the wages and tips subject to this withholding in column 1, and then multiply by 0.009 for column 2. And again, include tips even if you couldn't collect the employee's 0.9% share from their wages. The burden is really on the employer to track this $200,000 threshold for each individual employee.
Okay. And then line 5E just pulls all those Social Security and Medicare taxes together.
Correct. Line 5E is simply the sum of all those calculated tax amounts from column 2 of lines 5A, 5B, 5C, and 5 pence. It gives you your total combined Social Security and Medicare tax liability for the quarter before you get to any adjustments or credits.
Gotcha. Next is line 5F, section 3121Q, notice and demand tax due on unreported tips. This sounds like something you definitely don't want to get from the IRS.
You are absolutely right. This is a line you definitely hope stays at zero. This line only comes into play if the IRS itself determines that your employees failed to report tips or underreported them, and they send you, the employer, a formal notice and demand under section 3121Q. The crucial point for you as the employer is that you are not liable for your employer's share of Social Security and Medicare taxes on these previously unreported tips until you receive this specific notice from the IRS.
So the liability only kicks in when they send the notice.
Exactly. Once you get that notice, the tax amount shown on it becomes due. You have to deposit that tax according to your regular deposit schedule, treating the liability as accumulated on the specific date of notice and demand printed right on the notice. It's a very specific IRS-initiated liability.
Okay, hopefully not something most listeners encounter. So line 6, total taxes before adjustments. Pretty straightforward addition after all that, right?
Yes, line 6 is just simple addition. You take the federal income tax withheld from line 3, add the total Social Security and Medicare taxes from line 5E, and add any amount from that line 5F notice and demand, if applicable. That gives you your initial total tax liability for the quarter before we factor in any adjustments or those valuable credits.
Right. Now let's talk adjustments. Lines 7 through 9, these seem a bit more nuanced, need some precision, but I guess they're important for getting the final number exactly right. Line 7, fractions of cents, sounds tiny, but points to how exact the IRS wants things.
It is usually tiny in dollar terms, but it's actually crucial for making sure your Form 941 reconciles perfectly with the IRS's automated systems. Line 7 accounts for those minuscule differences that can happen because of rounding when calculating the employee share of Social Security and Medicare taxes withheld from each paycheck. Because the tax rates are percentages, sometimes the total withheld from all employees may be off by a fraction of a cent compared to the strict mathematical calculation on the total wages. This line 7 adjustment can be positive or negative just to make everything balance perfectly.
Okay, makes sense. Line 8 is current quarter's adjustment for sick pay. Now, this sounds like one of those areas that can get really complex, especially if you use third-party sick pay providers. What's the main takeaway here?
Yeah, this is definitely a common point of confusion. The most important thing to understand about line 8 is that it's primarily used when your business has third-party sick payers, maybe an insurance company, who are not acting as your agent. In that situation, the third party might handle withholding and depositing the employee's share of Social Security and Medicare taxes. Sometimes they might handle the employer's share too. Sometimes they transfer that liability back to you.
So the adjustment depends on who handled what.
Exactly. For example, if the third party paid the sick pay, withheld and deposited the employee's share of FICA taxes, but transferred the liability for the employer's share back to you, then you would make a negative adjustment here on line 8 for the employee's share that the third party already took care of. It's basically making sure the taxes are attributed correctly and nobody pays twice. If the third party is acting as your agent, usually no adjustment is needed here because you'd report everything as if you paid it yourself. It really boils down to who held the liability for which part of the tax and who actually paid it.
Okay, that clarifies a potentially tricky spot. Lastly, for adjustments, line 9. Current quarter's adjustments for tips and group term life insurance.
Right. Line 9 is specifically for negative adjustments in two main situations. First, and probably more common, is where you report the uncollected employee share of Social Security and Medicare taxes, specifically on tips. Remember we talked about having to report all tips even if you couldn't withhold the tax? This is where you back out that uncollected employee portion. The tax is still technically owed by the employee, but you couldn't get it from their wages.
And the second situation.
Group term life.
Yeah. The second is for the uncollected employee share of Social Security and Medicare taxes on the cost of group term life insurance premiums that you might provide to former employees if that cost exceeds $50,000. Again, it's tax the employee owes but you couldn't collect. These uncollected amounts also need to be reported specifically on the employee's Form W-2.
Okay. So line 10, total taxes after adjustments, is basically your final adjusted tax liability before we even think about credits. Precisely. Line 10 is the net result. You take line 6, total taxes before adjustments, then add or subtract those specific adjustments from lines 7, 8, and 9. This gives you your true adjusted total tax liability for the quarter. This is the key figure that any non-refundable credits will be applied against. Importantly, this line cannot be less than 0.
Okay, this is where it gets really exciting from a tax-saving perspective, and it's a point I think a lot of businesses might completely miss. Line 11. Qualified Small Business Payroll Tax Credit for Increasing Research Activities. This sounds like a really powerful tool for direct savings.
It absolutely is. This is a fantastic and frankly often underutilized opportunity for eligible small businesses. The Qualified Small Business Payroll Tax Credit for Increasing Research Activities, let's call it the R&D Payroll Tax Credit, allows qualifying businesses to directly offset their payroll tax liability because they've engaged in increasing research activities.
And the key is offset payroll tax liability, right? Not just a deduction against income.
Exactly. That's the power. It's not just a deduction reducing your taxable income. It's a dollar-for-dollar reduction of the actual tax you owe the IRS. This can lead to really significant tangible cash flow benefits for your business. Real money stays in your bank account.
And I remember hearing the Inflation Reduction Act of 2022 actually boosted this credit quite a bit.
It certainly did. That legislation was a big deal for this credit. It doubled the maximum amount a qualified small business could elect to apply against its payroll taxes, increasing it from $250,000 to $500,000 per year for tax years beginning after December 31st, 2022. That makes it a much more substantial benefit, potentially freeing up serious capital for innovative growing businesses.
Okay, so how does this translate into actual savings?
Yeah.
How does it physically get onto Form 941 and directly impact a business's cash flow? This feels like a major aha moment for our listeners.
It really is a critical insight. Okay, so first things first. To even claim this credit against payroll taxes, you have to make an election. You do this on Form 6765, credit for increasing research activities, which you file with your income tax return, and you have to make that election on or before the due date of that income tax return, including any extensions.
So the election happens with your income tax return before you use it on the 941.
Correct. Then the credit actually gets applied against your payroll taxes starting in the first calendar quarter that begins after you filed the income tax return making that election. So, for example, if you filed your 2024 income tax return with the Form 6765 election on, say, April 15th, 2025, the credit would start applying against your payroll taxes on your Form 941 for the third quarter of 2025, the one covering July through September.
Okay, so there's a slight delay between filing the income tax return and seeing the benefit on the 941. How does it reduce the tax? Which tax gets hit first?
Right. Here's the crucial cash flow part. The payroll tax credit is first used to reduce the employer's share of Social Security tax for the quarter. This part is capped at $250,000 per year, claimed quarterly. If you have any credit left over after wiping out your employer's Social Security tax liability for the quarter, up to that limit, then the remaining credit reduces your employer's share of Medicare tax for that same quarter.
So it only hits the employer's share of Social Security and Medicare, not the employee's share or income tax withholding.
Exactly. That's a key point. It does not apply to the employee portion of FICA taxes you withheld, nor does it touch federal income tax withholding. It is purely a direct reduction of your employer payroll tax liability. This means the actual amount of money you have to deposit with the IRS goes down.
That's huge. What if the credit is larger than your employer FICA liability for that first quarter you use it? Does the rest just vanish, or does it carry forward?
Ugh, another fantastic feature and why it's such a valuable cash flow tool. It carries forward. Any credit remaining after you've reduced both your employer's share of Social Security and Medicare taxes for the current quarter, up to the limits, is simply carried forward to the next quarter. This carry forward means the credit keeps benefiting your business's cash flow in the following quarters until it's fully used up. It could potentially span several quarters.
And you need another form to track this quarterly usage, right?
Yes. To figure out exactly how much credit you can use in the current quarter and to claim it, you must complete and attach Form 8974, Qualified Small Business Payroll Tax Credit for Increasing Research Activities, to your Form 941 each quarter you're claiming the credit.
Wow. Okay, that is a fantastic illustration of how understanding these rules can directly impact your cash flow, reduce what you actually send to the IRS. Real savings. So line 12, total taxes after adjustments and non-refundable credits, is basically your final net tax liability for the quarter.
Exactly. Line 12 represents that bottom line calculated tax liability for the quarter. It's line 10, total taxes after adjustments, minus line 11, the R&D payroll tax credit claimed this quarter. This is the net amount your deposits for the quarter will be measured against. And again, like line 10, this line cannot be less than 0.
Okay, which logically brings us to line 13, total deposits for this quarter. This is where you add up everything you've already paid in, right?
Correct. Line 13 is where you enter the total sum of all the actual federal tax deposits you made specifically for this quarter. This also includes any overpayment from a prior quarter that you specifically requested to be applied to this current return. And it includes overpayments that might have resulted from filing a corrected return, like a Form 941X, for a previous period that you're applying now. It's basically the total money your business has already sent to the IRS towards this quarter's employment taxes.
Okay. Then we have line 14, balance due. The moment of truth. This is where you might find out your business still owes money. What are the best ways to handle paying this? And what should businesses be really careful about here to avoid extra costs?
Right. If line 12, your total tax liability, is more than line 13, your total deposits, then yes, you have a balance due. You enter that difference, the amount you still owe, on line 14. Now, paying this balance due correctly and on time is critical to avoid penalties. The primary method, the one the IRS strongly encourages, is electronic funds transfer, or EFT.
So using things like EFTPS.
Exactly. Using the Electronic Federal Tax Payment System, EFTPS, is highly recommended. You can also use IRS Direct Pay for business payments now, or pay directly through your IRS online business tax account if you have one set up. Electronic is definitely the preferred way.
Can you use a credit or debit card to pay this balance due?
You can, yes. You can pay a balance due on the return using a credit or debit card through IRS-approved payment processors. But be aware, the processor will charge you a fee for that service. It's not free. And here's a really important caution. You should never use a credit or debit card to make your regular federal tax deposits throughout the quarter. Those must be made via EFT. Credit debit cards are only an option for paying the balance due shown on the filed Form 941 itself.
Okay, good distinction. What about checks? Is that still an option?
For smaller balances due, if you didn't make timely deposits and you're paying with the return, check or money order might be an option, but it's generally discouraged. If you do pay by check, you absolutely must complete and include Form 941V, the payment voucher, with your payment and return. And if you're filing Form 941 electronically, you usually have the option of using Electronic Funds Withdrawal, EFW, to authorize a direct debit from your bank account for the balance due amount in one go when you file.
What if a business can't pay? If the cash flow isn't there to cover the full balance due by the deadline, are there any options besides just facing penalties immediately?
Yes, the IRS does have options, though they come with costs. If you find yourself in that tough spot and the total amount you owe is $25,000 or less across all tax types, you might be eligible to apply online for an installment agreement. You generally need to show you can pay the full liability off within 24 months. This offers a path to compliance if cash is tight, absolutely. But it's important for you to know that installment agreements aren't free. They incur setup fees, and you'll still be charged penalties and interest on the unpaid balance until it's fully paid off. It stops harsher collection actions, but the costs continue to accrue.
Right. And you mentioned a crucial warning earlier about paying with the return versus depositing.
Yes, and it's worth repeating because it directly relates to avoiding penalties, which is a form of tax saving. The IRS instructions specifically warn, if you pay an amount with your Form 941 that, according to your deposit schedule rules, should have been deposited earlier via EFT, you may still be hit with failure to deposit penalties. This really hammers home the importance of understanding your deposit schedule, whether you're monthly or semi-weekly, and making those required deposits throughout the quarter on time. Don't just wait until the Form 941 deadline and try to pay a big lump sum then if it should have been deposited earlier. Understanding and following those deposit rules is a direct way to avoid costly penalties. That's real savings for your business.
Absolutely crucial point. And finally, the flip side, line 15, overpayment. A much happier line to see, I guess.
Definitely a better outcome. If your total deposits on line 13 are greater than your total tax liability on line 12, congratulations, you have an overpayment. On line 15, you simply check one of two boxes. Either you want the IRS to apply that overpayment to your next quarter's return, essentially giving you a head start, or you want them to send you a refund check or direct deposit.
What if you forget to check a box?
Good question. If you don't check either box, the IRS default action is to automatically apply the overpayment to your next return. And a small note, if the overpayment is less than $1, they won't automatically refund it or apply it unless you specifically ask them to in writing.
Okay, let's just take a quick breath there.
Right.
Because now we're shifting into part 2 of Form 941, and this is all about deposit schedules. This feels like arguably the most critical section for actively managing cash flow and, as we keep saying, directly avoiding penalties. It really ties into our whole theme of tax savings through smart compliance.
You are absolutely right. Understanding your deposit schedule, it's not just some bureaucratic hoop to jump through. It directly dictates when you have to pay your employment taxes and how much you need to have ready. Getting this wrong leads straight to failure to deposit penalties. They can be substantial. They can really add up and eat into your profit unnecessarily. So yes, mastering this is a crucial tax-saving strategy. And as we mentioned before, just to reiterate, virtually all federal tax deposits must be made using electronic funds transfer, EFT, no paper checks for deposits.
Okay. So how does an employer figure out their schedule? Are they a monthly depositor or a semi-weekly depositor? It sounds like it's not something you just choose.
Definitely not a choice. It's determined by very specific IRS rules, and it's based entirely on your past tax liability. It's almost like your business's financial fingerprint for deposit purposes. The IRS uses what they call a look-back period. Now, this period is always the 4 quarters ending on June 30th of the prior year. So specifically, it's July 1st of the second preceding calendar year through June 30th of the immediately preceding calendar year.
Okay, that sounds a bit complicated. Can you give an example? Like for filing in 2025?
Sure. So if you're determining your deposit schedule for calendar year 2025, your look-back period is July 1st, 2023 through June 30th, 2024. That specific 12-month window. You then need to look at the total employment taxes, the amount on line 12, essentially, that you reported on all your Forms 941 filed during that entire look-back period. Add them all up.
Okay, so you get that total tax figure from the look-back period. And then based on that number, you fall into one of two categories for the entire current calendar year.
Exactly. It sets your schedule for the whole year, usually. If your total taxes reported during that entire look-back period were $50,000 or less, Then you are designated as a monthly scheduled depositor for the entire current calendar year.
And what does monthly depositor mean in practice?
It means your deposits are generally due by the 15th day of the next month, covering the tax liability you accumulated during the previous month. So, for example, all the taxes associated with wages paid in January would need to be deposited by February 15th. It's a relatively straightforward monthly rhythm.
Okay. But what if your taxes in the look-back period were more than $50,000?
Then you are designated as a semi-weekly scheduled depositor for the entire current calendar year. And the schedule is definitely a bit more nuanced and requires closer attention. The rule is, if your payday falls on a Wednesday, Thursday, or Friday, your deposit covering the liability from those paydays is due by the following Wednesday. If your payday falls on a Saturday, Sunday, Monday, or Tuesday, your deposit for those liabilities is due by the following Friday.
Okay, so it's tied directly to your paydays within the week. And semi-weekly depositors have to file an extra form with their 941.
Correct. Semi-weekly scheduled depositors must complete and attach Schedule B, Form 941, which is the report of tax liability for semi-weekly scheduled depositors. On Schedule B, you have to break down your daily tax liability for the entire quarter. It's much more detailed than the monthly schedule reporting.
Now, I remember you mentioning a critical trigger earlier. Somebody could flip your schedule mid-year, even if your look-back period said you were monthly. The $100,000 next day deposit rule. That sounds like a potential curveball for businesses.
It absolutely is. This is a very important rule that can catch businesses completely off guard and have a huge immediate impact on cash flow. Here's how it works. If you accumulate $100,000 or more in employment tax liability on any single day during a deposit period, either monthly or semi-weekly, then you immediately trigger this rule. The deposit for that $100,000 or more liability is due by the close of the next business day. And crucially, you are automatically switched to being a semi-weekly scheduled depositor starting the very next day, and you remain on that semi-weekly schedule for at least the rest of the current calendar year and for the entire following calendar year, regardless of your look-back period liability.
Wow. So hitting that $100 K mark on one day has long-term consequences for your deposit frequency.
Absolutely. And another critical point, that $100,000 threshold is determined before you consider any reduction in your liability from non-refundable credits, like that R&D payroll tax credit we discussed.
Oh, okay. So even if the R&D credit will ultimately reduce the final tax you owe below $100 K, if the gross liability hits $100 before applying the credit, you still trigger the next day rule.
Exactly. The rule looks at the liability accumulated on that day before credits are applied. It's a key trigger point you absolutely have to monitor closely, especially around large payrolls or bonus runs.
It's a massive shift in cash flow demands. Is there any kind of relief for really small amounts due?
Yeah.
A de minimis exception for deposits?
Yes, thankfully there is. This can be very helpful for truly small businesses or maybe businesses in a slow quarter with minimal liability.
Yeah.
The rule is, if your line 12 amount, that's your total taxes after adjustments and non-refundable credits, is less than $2,500 for either the current quarter you're filing for or the immediately preceding quarter, and you did not incur that $100,000 next day deposit obligation at any point during the current quarter, then you are not required to make separate deposits throughout the quarter.
So in that specific case, you can just pay with the return.
Correct. In that specific scenario, you can simply pay the full amount due, if any, with your timely filed Form 941 by the deadline. It significantly simplifies the process for those with very low quarterly liabilities.
Okay. And when you're actually filling out Part 2, either line 16 for the monthly folks or that detailed Schedule B for semi-weekly, what's the critical thing to remember about the number you're putting there? Because you mentioned this can impact penalties too.
Yes, this is vital. It's absolutely crucial to remember that line 16 for monthly and Schedule B for semi-weekly are used to report your tax liability day by day or month by month. That means you report the liability based on when the wages were paid and the liability was actually incurred. You are not reporting the dates you actually made your deposits. This is a very common mistake, and it can lead to IRS inquiries and potentially failure to deposit penalties, even if you ultimately paid the right total amount.
So if you're semi-weekly and you put the wrong liability on the wrong day in Schedule B, that's a problem.
Big problem. For semi-weekly depositors using Schedule B, if you don't properly report your daily liabilities accurately, or if you maybe mistakenly try to report monthly totals on line 16 instead of using Schedule B, the IRS might assess what they call averaged failure to deposit penalties. Those can be costly. The key check is the total liability you report across all the days or months in Part 2, line 16, or Schedule B must exactly equal the total tax shown on line 12 of your Form 941. They have to match perfectly.
Okay, so let's loop back to that Qualified small business payroll tax credit for increasing research activities. Line 11. How does that credit specifically impact my calculation of liability for deposits? This feels like a really crucial connection for unlocking those tax savings and managing cash flow day to day.
This is absolutely where the rubber meets the road in terms of the credit providing immediate cash flow benefits. It's a direct tax-saving mechanism tied precisely to your deposit requirements. Remember that R&D payroll tax credit directly reduces the actual tax liability you owe the government.
Yeah.
And we know it reduces the employer's share of Social Security tax first, up to the limits, and then the employer's share of Medicare tax.
So when I'm calculating my deposit needed after a payroll run, I should factor that credit in right then.
Exactly. That's the key. When you are determining your tax liability for each payroll period, the liability that dictates how much you need to deposit according to your monthly or semi-weekly schedule, you should take this credit into account right then and there. For instance, if you're a semi-weekly depositor calculating your liability for a specific payday to report on Schedule B, you will calculate the gross employer FICA liability and then reduce that liability by the allocable portion of the R&D credit for that pay period. You apply it first against the employer Social Security tax component, then against the employer Medicare tax component.
So the amount I actually need to deposit is lower because of the credit.
Precisely. By understanding and correctly applying this credit when you calculate your required deposit amounts, you are preventing yourself from over-depositing money to the IRS money that you don't actually owe them because the credit offsets it. This directly prevents overpayments, keeps cash in your business longer, and significantly improves your immediate cash flow. This is a real, tangible saving because you're holding onto your funds and only sending the net amount truly due after the credit is factored in. And crucially, as long as you calculate it correctly, you won't incur penalties for underdepositing because the credit legitimately reduces the liability that was due. It's truly integrating tax compliance with smart, proactive financial strategy.
That is incredibly helpful. It really paints a clear picture of how getting into the weeds on these forms, especially with things like credits, directly translates into managing your business's money more effectively day to day. Okay. Let's briefly touch on the remaining parts, parts 3, 4, and 5 of Form 941. These are more about business specifics and signing off. Part 3 is tell us about your business.
Right. Part 3 is mainly for providing some administrative details about your business's current status that helps the IRS understand your filing pattern and situation. Line 17 is important if things change significantly. You check this box if your business has actually closed or if you've stopped paying wages permanently. If you check this box, this Form 941 becomes your final return. You'll also need to enter the final date you paid wages, and the IRS requires you to attach a brief statement explaining where your payroll records will be kept for the required retention period. And line 18, as we discussed earlier, is specifically for seasonal employers. Checking this box tells the IRS, don't expect a return from us every single quarter, which helps you avoid those unnecessary inquiries when you legitimately have no tax liability because you're out of season. Just remember to check it on every Form 941 you do file during your active season.
Okay. Then part 4. May we speak with your third-party designee? This seems like it could be a big time saver, allowing collaboration on compliance issues.
Yes, Part 4 can be a really valuable feature for many businesses, especially if you work with an external accountant, a payroll service, or even have a dedicated internal payroll manager handling these filings. By checking yes here and providing the designee's information, you authorize that specific third party to discuss this specific Form 941 with the IRS on your behalf.
What kind of things can they discuss?
It allows them to do things like provide missing information if the IRS calls, call the IRS themselves to ask about processing status or updates, and respond to certain types of IRS notices, particularly those about basic math errors on the return. It's basically a way to facilitate communication and help resolve simple issues more quickly without you, the business owner or principal officer, having to be the sole point of contact for every little IRS query related to that form.
Does that authorization last forever? Can they sign things for you?
No, definitely not. It's important to understand the limits. This authorization automatically expires 1 year from the original due date of the return. And it does not authorize the designee to bind you to any agreements, to represent you in broader examinations or appeals, or receive refund checks. It's purely for discussing that specific return.
Got it. And finally, part 5. Sign here. The official sign-off. Non-negotiable, obviously.
Correct. Form 941 is not valid unless it's properly signed on page 2. The person authorized to sign depends on the business structure. For a sole proprietorship, it's the individual owner. For a corporation, like an S Corp or C Corp, it has to be the president, vice president, or another principal officer who is duly authorized to sign. For a partnership or an LLC treated as a partnership, it's a responsible and duly authorized partner, member, or officer. For an LLC treated as a corporation or a single member LLC, it's usually the president, owner, or principal officer. And for a trust or estate, it's the fiduciary.
Can they use a stamp or machine signature?
Corporate officers or authorized agents can sometimes use an alternative signature method, like a rubber stamp or a mechanical device, but only if they meet very specific IRS requirements regarding authorization and usage. It's not just automatic. And critically, if you use a paid preparer, someone who you pay to prepare the return who isn't just an employee of your firm, they must complete the paid preparer use only section at the bottom. They have to sign it manually, provide their preparer tax identification number, TTIN, and fill in their firm's information. This holds them professionally accountable for the preparation.
Okay, so we've really walked through the form line by line, hitting those key areas that impact not just your tax liability, but also your cash flow and potential savings. Let's try to bring this all together now, some overarching strategies for maximizing efficiency and, maybe more importantly, avoiding those costly pitfalls. Because, like we said, avoiding penalties, it's arguably the most direct form of tax savings any business can achieve.
Absolutely. Couldn't agree more. The first major point, maybe the most impactful for efficiency, is really embracing electronic filing and payment. The IRS strongly encourages both, and for very good reasons. Electronic filing Form 941 is convenient, it's generally more secure than mail, and it significantly reduces your worry about mail delays, lost documents, things like that. You usually get confirmation much faster, too. And as we've hammered home, virtually all federal tax deposits absolutely must be made electronically, using systems like EFTPS, IRS Direct Pay, or your IRS business tax account online. These are necessities now. Fully embracing these electronic methods truly saves time, cuts down administrative burden, and provides a lot more peace of mind. That translates directly into efficiency, which is definitely a form of savings.
And it's not just about filing the 941 accurately in isolation, is it? It has to match up with other things you file, like the annual W-2s and the W-3 transmittal form. Discrepancies there can raise red flags.
That's a critical compliance checkpoint, and one that trips up businesses more often than you'd think. The IRS and the Social Security Administration, SSA, have systems that specifically match the totals reported on your 4 quarterly Forms 941 throughout the year with the grand totals reported on your annual Form W-3, which is the transmittal of wage and tax statements, and the sum of the individual employee Forms W-2 attached to that W-3. They are specifically reconciling things like total federal income tax withheld, total Social Security wages, total Social Security tips, total Medicare wages and tips. If there are discrepancies between your quarterly 941 totals and your annual W-3, W-2 totals, even seemingly small ones, it is very likely going to trigger contact from the IRS or the SSA asking for clarification.
So accuracy and consistency throughout the year, quarter by quarter, is paramount.
Absolutely. It helps avoid those unnecessary inquiries, potential delays in processing W-2s for your employees, and maybe even audits down the line.
What happens if a business does find an error? Say, after they've already filed a Form 941 for a past quarter. What's the right way to fix it? Can they just adjust it on the next quarter's return?
No, definitely not. That's a common misconception. You should not try to correct an error from a previous quarter by adjusting numbers on your current quarter's Form 941. That will just create reconciliation nightmares for both you and the IRS. If you discover an error on a previously filed Form 941, the only correct procedure is to file Form 941X, which is the adjusted employer's quarterly federal tax return or claim for refund.
Okay, Form 941XX, and it's filed completely separately.
Yes, it's filed completely separately from your regular Form 941. A really positive development in recent years is that you can now file Form 941X electronically, which definitely simplifies the correction process and can speed up getting any refund or credit you might be due because of the correction. But the key is, use Form 941X for corrections. Don't try to fix past mistakes on the current 941.
Got it. Now let's circle back hard to avoiding penalties and interest, because this is maybe the most direct and impactful tax saving strategy available, just not paying extra money you didn't need to pay. What are the absolute core actions businesses need to take to prevent these costly additions?
Preventing penalties really just boils down to being consistently accurate and timely in your compliance efforts. It's not necessarily complicated, just requires diligence. You can generally avoid nearly all penalties and interest if you consistently do all of the following things. First, deposit or pay your taxes when they're due based on your correct deposit schedule, monthly or semi-weekly, remembering that $100 K rule. Timeliness is paramount. Second, file your fully completed Form 941, both pages, on time, by the due date or the extended due date if applicable. Third, report your tax liability accurately on the form itself and on any required attachments like Schedule B if you're semi-weekly. Make sure line 12 matches Part 2. Fourth, if you are paying by check, which again is rare now, make sure it's a valid check that clears. EFT is much safer. Fifth, furnish accurate Forms W-2 to all your employees by the January 31st deadline. And sixth, file your Form W-3 transmittal and copy A of all those Forms W-2 with the Social Security Administration on time and accurately, also typically by January 31st.
So basically, do everything right and on time.
Pretty much. Failure in any one of those key areas, late deposits, late filing, inaccurate reporting, bad checks, incorrect W-2s or W-3 can trigger significant penalties and interest charges. And that money comes directly out of your business's bottom line. Money that could have been reinvested, used for payroll, anything else. That's why avoiding penalties is a form of savings.
You mentioned trust fund taxes earlier and a particularly severe penalty related to them. Can you expand on that? It sounded quite daunting.
Yes, this is an extremely serious penalty, and it's one the IRS pursues aggressively. It's called the Trust Fund Recovery Penalty, or TFRP. This penalty can be assessed for the full amount, 100% of the unpaid trust fund taxes. Now, what are trust fund taxes? They are the federal income tax, the employee's share of Social Security tax, and the employee's share of Medicare tax that you, as the employer, are required to withhold from your employees' paychecks.
Why trust fund?
They're called trust fund taxes because the law considers that money to be held in trust for the U.S. Treasury from the moment you withhold it. It doesn't belong to your business, it belongs to the government and the employee. If these withheld taxes are not properly collected, not accounted for correctly, or, most critically, not paid over to the U.S. Treasury when they're due, the IRS can impose this TFRP.
And who gets hit with this penalty? Just the business entity?
No, and this is the really daunting part. The TFRP can be imposed personally, not just on the business, but on any individuals the IRS determines were responsible persons for collecting, accounting for, or paying over these taxes, and who acted willfully in failing to do so.
Responsible persons.
Yeah.
Who could that include?
That could potentially include business owners, corporate officers like the president, treasurer, CEO, directors, shareholders, possibly even payroll managers or bookkeepers, depending on their level of control and authority over your business's finances and decision-making regarding paying bills and taxes. Willfully generally means they knew the taxes were due, but intentionally or recklessly disregarded the obligation to pay them.
Wow. 100% personal liability. That's a very, very strong motivator for getting payroll taxes right.
Absolutely. It underscores the profound fiduciary responsibility that comes with being an employer and handling other people's money, because that's essentially what withheld taxes are.
So if, despite best efforts, you do receive a penalty notice from the IRS related Form 941, what's the recommended way to respond? Should you attach an explanation to your next return?
No, definitely don't attach explanations about penalties to your Form 941 itself. That's not the correct channel and will likely get overlooked. If you receive a notice proposing a penalty, you should reply directly to that specific notice, following the instructions provided in the notice. You typically send a written explanation outlining why you believe the penalty should not be charged, perhaps providing documentation supporting your case for, say, reasonable cause for the failure that led to the penalty. The IRS will then review your explanation and determine if your situation meets the criteria for penalty abatement.
Okay, good practical advice. For our listeners who want to dive even deeper after this, or maybe need help with a specific situation, what are the best official IRS resources to point them towards?
The IRS actually provides a wealth of really comprehensive resources online and in print. The absolute go-to guide for almost all employment tax topics is Publication 15, the Employer's Tax Guide, also known as Circular E. It's very detailed. You can also find information specific to Form 941 itself, including the instructions, right at irs.gov Form 941. For really getting into the weeds on federal income tax withholding methods, Publication 15T is the resource. If you have general questions about Form 941 or the deposit rules, you can try calling the IRS Business and Specialty Tax Line, though wait times can vary. Their number is usually listed in the Form 941 instructions. There are also TDD, TTY numbers for accessibility. And specifically for deposit inquiries or issues with using the electronic federal tax payment system, EFTPS.gov is the website, and they have their own dedicated customer service helpline numbers listed there as well.
Great list of resources. And just as a final, slightly surprising insight into the real-world effort all this compliance takes. The IRS actually includes estimates of taxpayer burden right in the Form 941 instructions.
They do, and it's actually quite revealing when you look at it. For filers of Form 941, the IRS estimates the average annual burden per business is somewhere around, I think, 64 hours of time.
64 hours. Just on this one form series.
Well, that includes the related tasks, record keeping needed for the form, learning about the law or the form changes, actually preparing the forms, and then copying, assembling, and sending the form. And beyond the time, they also estimate an average out-of-pocket cost associated with Form 941 compliance of around $2,743 per year. That could be for tax preparation software, professional fees, things like that.
Wow. That's not trivial at all. It really illustrates the tangible time and financial commitment involved in just staying compliant.
Exactly. It's not just a theoretical burden. It's very real for businesses. And it really underscores the immense value of understanding these processes as thoroughly as possible. The more informed you are, the more efficient you can become, maybe by leveraging things like the R&D credit, avoiding penalties, using electronic systems effectively, the more you can potentially reduce that burden. You can turn what feels like a chore into a more optimized business function, freeing up those valuable hours and dollars for other priorities, like actually growing your business. You know, what really stands out to me from our whole discussion today is how understanding Form 941 goes so far beyond just like ticking boxes for compliance. It's much more strategic than that. That qualified small business payroll tax credit for increasing research activities we talked about, that's a prime example. It's not just some line item. It's a direct, tangible reduction in your actual payroll tax liability. It frees up real cash that stays in your business. And honestly, just diligently adhering to your deposit schedule, getting your reporting right, that is the primary form of tax savings most businesses can achieve here. Simply by preventing those hefty and often entirely avoidable penalties, it really shifts the mindset from obligation to proactive financial stewardship.
Absolutely. So as you, our listener, reflect on this deep dive we've taken into Form 941, maybe consider this. Beyond just filing accurately and on time, how does the strategic management of your payroll taxes actively leveraging credits like the R&D credit, really optimizing your deposit timing based on your schedule? How does that integrate into the broader financial health and the growth strategy of your business? What new opportunities or maybe just efficiencies might you uncover by looking at compliance not solely as an obligation you have to meet, but as an integral part of optimizing your entire business operation? Thank you so much for joining us on this deep dive today. We hope it's given you some valuable insights, and we really encourage you to continue your learning journey.